Good morning. My name is Gavin Neo-Smith. Thank you for joining me today to have a look at JPMorgan. This first slide just gives us an idea of what we're going to be looking at today. So starting off with the nature of the business, these are the four operating divisions of JPMorgan. The first is Consumer and Community Banking, then it's Corporate and Investment Bank, Commercial Banking, and Wealth and Asset Management. Just for future reference, when I use the term retail, I'm referring to the consumer bank, and when I use the term wholesale, I'm referring to both corporate and commercial banking. So the consumer business consists of products that we're all quite familiar with, such as transactional services, credit cards, home loans, and vehicle finance. The corporate and investment bank, or CIB, is the largest division, making up 46% of earnings. This consists of banking. Inside banking is investment banking. Here, fees are earned from helping clients issue new shares or raise debt, as well as from advising on mergers and acquisitions. Banking also includes lending and treasury services. The other component of CIB is markets. This is the largest part of CIB and largely consists of trading activities, which are highly dependent on market conditions. This business fares well when markets are volatile because more trading occurs and the spreads earned on these trades typically expand. Banks that earn a higher portion of their income from trading typically have more volatile earning streams. I'm definitely not saying that lending is a low-risk business, but in the absence of defaults, it is more recurring in nature. Commercial banking serves clients between business banking and CIB. It consists of middle market, corporate, and the commercial real estate portfolio. The middle market includes clients with revenues between $20 million and $500 million. Corporate clients have revenues between $500 million and $2 billion. Lastly is wealth and asset management. This business caters for all clients from consumers to large corporates. Moving on to our recommendation. So JPMorgan has strong franchises with market-leading positions in several categories. They have also demonstrated sound execution, which has been driving market share gains. A good example of this has been in the commercial banking business. In the medium term, we expect the return on equity to improve. This is the primary input into our valuation. Higher capital returns in the form of dividends and share repurchases should lift the ROE. The proposed changes under the Trump administration could potentially be a catalyst for the sector as a whole, specifically with reference to tax reforms and deregulation. However, given the uncertainty about if or when these changes may come into effect, we do not account for this in our valuation. In conclusion, we see value in the share and recommend an overweight position with an exposure up to 6% of your portfolio. Moving over to the financial review. Net interest income, or NII, increased by 7%. You can think of net interest income as a difference between interest earned on loans and the interest paid on deposits that are used to fund these loans. There are also other assets and liabilities that bear interest, but for simplicity's sake, I'm not going to get into the details. So the 7% growth was driven by a 6% increase in average loans and a higher net interest margin of 2.32%, up from 2.28%, which benefited from higher interest rates. Just to get into this into more detail, when the Fed increases interest rates, a bank will increase the rates it charges to its clients. The rates on deposits will also increase, but this is more sticky in the earlier stages of the interest rate cycle, even more so in retail deposits. Rates on deposits are also a function of competition, so if the banks aren't having difficulty attracting new deposits, they are less likely to increase their offered rates. This is what is referred to as a deposit reprice beta, so it is essentially the change in deposit rates in response to a change in market interest rates. Credit provisions are a charge on the income statement used to change the allowance for bad debts. This reduced by 22% due to a reserve release in the wholesale energy portfolio, offsetting increases in the retail book. I'm going to get into this in more detail in the divisions. Non-interest revenue, or NIR, only increased by 1%. This was due to new card acquisition costs, weaker mortgage banking income, and a weaker performance in CIB's markets business in the second quarter. Again, I'm going to get into this into more detail in the divisions. The overhead ratio, more commonly known as the cost-to-income ratio to those who follow local banks, is expenses divided by net revenue. This measures the operating efficiency of the business. Net revenue is a sum of both net interest income and non-interest revenue. The overhead ratio increased slightly to 59% from 58% as operating expense growth of 5% was ahead of the growth in net revenue. Adjusted EPS increased by 16%. However, there's quite a significant tax benefit in this number. In the first quarter, there was a benefit of $373 million from an increase in the group's share price for vesting employee stock-based compensation. EPS was also supported by a 3% reduction in the weighted average number of shares as a result of ongoing share repurchases. Net asset value per share increased by 5% to $66.05, and the return on equity improved to 11% from 10%. Now looking at the divisions and starting with consumer and community banking. Net interest income was up 5%, driven by a 4% increase in average loans with good growth in both the mortgage and card portfolios of 8%. Credit provisions grew by 36%. In card, there were both higher charge-offs and a reserve build. This has to do with the recent growth in the business. This new business is expected to have higher charge-offs, but management has indicated that it offers better risk-adjusted margins. So that this means that the net interest margins on this business justifies the additional risk. One of the products that has been driving this growth in the card business is the Sapphire Reserve card. This is more of an upper market product with attached loyalty benefits. It is attracting the type of customer that management are looking for, increasing the number and quality of customer interactions. This builds closer customer relationships, which in turn improves cross-sell opportunities, meaning that it's easier to offer these clients additional products like mortgages and so on. Getting back to credit provisions, the higher charge also reflects write-downs in the student portfolio that occurred in the first quarter. This is a business that JPMorgan is exiting, and this was offset by credit improvements in mortgage, driven down by lower bad debts and improving house prices. Non-interest revenue was down 12%. The growth in card was a big contributor to this. This is because the cost of acquiring these cards is expensed to the revenue line. However, this should improve as this business matures. Mortgage banking income was also down sharply. The market has become increasingly more competitive, affecting profitability. One reason for this is the shift from refinancing to new purchases. For example, when interest rates are low, a client will more likely take out a loan at, let's say, 1% to refinance the loan they are currently repaying on their home at, let's say, 2%. With rising interest rates, this is less likely to occur. Refinancing is also less competitive than new purchases because clients tend to remain with their existing bank. The overhead ratio increased from 54% to 58%. Net income fell by 18% and the return on equity dropped to 16% from 19%. Moving over to the corporate and investment bank. The banking business performed well with net revenue up 21%. Recall that net revenue is the sum of net interest income and non-interest revenue. This growth was achieved across the businesses with investment banking fees up 23%, treasury services up 15% and lending up 32%. The markets business was flat due to a weaker result in the second quarter, although this was expected due to the higher market volatility ahead of Brexit in the previous period. Credit provisions were a net positive of $149 million compared to a negative of $694 million in the previous period. This was due to reserve releases in the oil and gas portfolio, which were built up in the previous period. Management are comfortable with the level of provisions in this business despite lower oil prices. Flat expenses, together with good revenue growth, resulted in a lower overhead ratio of 54% compared to 57%. Net interest income was up 33% with a higher ROE of 16% compared to 13%. Moving on to commercial banking. Net interest income was up strongly by 18% with average loan growth of 12%. This chart here shows that the growth was achieved across products with middle market up 7%, corporate up 12%, commercial term lending up 13% and real estate up 30%. Credit provisions were also a net positive here for similar reasons as in CRB with reserve releases in the energy sector. The overhead ratio improved somewhat to 39% from 40%. The good top-line performance was offset by investments into staff and technology. Net income came in 43% higher, and the ROE improved to 16% from 14% in 2016. And lastly is wealth and asset management. This business benefited from higher assets under management, up 11% from a year ago. This was driven by higher market levels, net inflows of $17 billion into long-term products, partly offset by outflows of $6 billion into liquidity products. Liquidity products are essentially money market funds, which tend to have more volatile flows. The higher asset base supported a 4% increase in non-interest revenue. Net interest income came in 13% higher, in line with the growth in average loans. The overhead ratio deteriorated to 76%, up from 71%. This was due to higher legal expenses in the first quarter. Ultimately, net income was down 9%, and the ROE dropped from 24% to 22%. Moving on to capital and liquidity. So I'm going to start off by just explaining two of these ratios, being the Common Equity Tier 1 Capital Ratio, or CET1, and the Supplementary Leverage Ratio, or SLR. Starting with the CET1, it is Common Equity Tier 1 Capital, which is essentially the tangible net asset value of the business, divided by risk-weighted assets. Risk-weighted assets are, as the name implies, assets weighted by risk. For example, I'm going to take two asset classes, cash and loans. Cash has low or very little risk. This means a low weight, which in turn means a lower denominator in the calculation and therefore a higher capital ratio. Loans are more risky, meaning they will have a higher weight, meaning a higher denominator and a lower capital ratio. Looking at the supplementary leverage ratio, so the main difference between this and the CET1 ratio is that assets are not weighted by risk. So in this case, cash and loans would be treated the same. The SLR only becomes a binding constraint to banks in 2018. Now looking at JPMorgan's capital position, the CET1 ratio is at 12.5%. This is at the upper end of the 12.5% to 11% target band. Management do believe they can operate this business at the lower end of this range over time. All things equal, a lower capital ratio will result in a higher return on equity. This can be achieved through capital returns to shareholders, being dividends and share repurchases. The chart in the bottom right corner shows this relationship. To achieve the target CET1 range of 12.5% to 11%, this implies a net payout ratio between 80% and 120%. The net payout ratio measures share repurchases and dividends as a percentage of earnings. So essentially what this chart tells us is that to reduce the CET1 ratio to 11%, JPMorgan would need to pay out more than 100% of its earnings back to shareholders. This slide shows the results of the 2017 CCAR. Firstly, what is CCAR, or the Comprehensive Capital Analysis and Review? It is an annual process undertaken by the US Federal Reserve to test the strength of financial institutions. It includes stress tests on capital under severe scenarios. Some of the assumptions are the economy falls into a recession, there are sharp decline in real estate prices, drop in equity markets, and a spike in credit spreads. So the table shows JPMorgan's results. It includes the actual ratio at the end of 2016, the regulatory minimum, and the stress ratios, the first being what the ratio would look like at the end of the first quarter of 2019, and the minimum quarterly ratio that would occur between 2016 and 2019. You can see that the CET1 minimum of 7.8% is still well above the regulatory minimum of 4.5%, but this is not a level that JPMorgan or any other bank would be comfortable operating at. So overall, the results came out positive. The results were actually positive for the sector as a whole. The Fed approved JPMorgan's plans to increase its shareholder payouts. This includes gross repurchasing capacity of $19.4 billion, around 6% of JPMorgan's market cap, a 12% increase in the quarterly dividend to 56 US cents. The chart in the bottom shows how JPMorgan fared relative to its competitors. The red block represents a drop from the 2016 level to the minimum. In JPMorgan's case, this is the difference between the 12.5% and the 7.8%, reflecting a 4.7% decline. On this measure, you can see that JPMorgan ranks in the middle of the pack. Moving on to liquidity. So why look at liquidity? Well, it gives us an indication of the bank's ability to meet with deposit withdrawals over a short time period. If some negative event had to occur, like what happened to African Bank, you as a depositor would want to withdraw your funds in a hurry. The bank must have sufficient cash on hand to allow you to do so. Although necessary, liquidity does have a cost. Because the high-quality liquid assets, or HQLA, that are required to be held in order to meet these outflows have very low returns. This has a drag on the return on equity. The liquidity coverage ratio, or LCR, is one of the measures used by regulators to measure liquidity compliance. This ratio must exceed 100%. It is calculated as high-quality liquid assets, which is essentially cash-type investments divided by the net short-term outflows. The diagram on the right shows how these outflows are calculated. I'm going to use a simple example, assuming a bank has one deposit of $100. If the deposit is locked in for at least 30 days, the bank can then use this $100 to lend out or invest for higher returns. If not, then it must be determined if the deposit is operating or non-operating. Operating deposits are typically used for transactional activities such as payroll and other business uses. They are therefore less likely to be withdrawn on short notice because this would disrupt the activities of the depositor. So if the $100 is an operating deposit, the bank must hold $25 or 25% of the deposit's value in cash or similar investment with a low return. They can then use the remaining $75 to lend out or invest with a higher return. Non-operating deposits are seen more like investments, meaning they are more likely to be withdrawn over a short time period. If the $100 was non-operating deposit, the bank would have to keep $40 or 40% in cash and then can use the remaining for other activities. Keeping the $40 in cash versus the $25 would result in a low return on equity. This means that banks will favor operating deposits over non-operating. So banks aren't required to report the LCR until August this year, but JPMorgan has stated that the LCR does exceed the 100% regulatory minimum. There have also been concerns in the markets that the normalization in the Fed's balance sheet will affect the liquidity position of banks. This is because it will result in an outflow of deposits. JPMorgan doesn't believe that this will have a material impact because they expect these outflows to occur from non-operating deposits, which already have more high-quality liquid assets to back these deposits. Also, the Fed has indicated that this process will occur gradually over time as to not disrupt financial markets. Lastly is the company guidance. So for the full year, the group is expecting credit charge-offs of around $5 billion, a 6% increase from 2016, adjusted expenses of $58 billion, a 3% increase, average core loan growth of 8%. This was revised down from the 10% guidance given at Investor Day, and this has been due to lower than expected loan growth in the first half of the year, and they've also noted more competitive conditions in mortgage lending. Incremental net interest income is expected to be $4 billion for the full year, an 8% increase from 2016. This number was also revised down from the $4.5 billion guidance given at the end of the first quarter. This was due to lower than anticipated net interest income in the second quarter, which was in part due to lower 10-year rates with the flattening of the yield curve. However, this did not affect the medium-term guidance of $11 billion in incremental net interest income by 2019, which equates to an annualized growth rate of 7%. This is based on implied interest rate movements, and we're going to show you the assumptions in the next slide. Other medium-term targets include a return on tangible common equity of 15%, it's currently at 14%, and a managed overhead ratio of 55%, it's currently at 57%, and lastly a net payout ratio between 55% and 75%. This slide shows JPMorgan's expectations for net interest income up until 2019. Here you can clearly see the impact of rising interest rates on net interest income. This is shown by the green area on the chart. Their base case of $11 billion in incremental net interest income is based on the applied direction of the federal funds rate. By looking at the smaller charts in the upper left, you can see that this includes 2 interest rate increases in 2017, another 2 in 2018, and then 1 in 2019. However, the direction of interest rates is not certain. Therefore, if rates don't evolve as implied here, it is unlikely that this guidance will be met. If rates are left unchanged, incremental NII is expected to be 6.5 billion, with the majority due to balance sheet growth and a change in the product mix. However, this case is no longer valid because we have already seen interest rate increases in 2017. That concludes my presentation. Thank you for listening.